Is recording on now?
Yes.
Thank you for reminding me. Okay, so we continue talking about financial statements. And here's balance sheet. And the question to you is, if stockholders' equity is already calculated on balance sheet, why would we care and try to somehow else estimate the company's value? Any ideas? Okay, so of course, true value of the company and the this stockholders' equity from the balance sheet, it may be different things, completely different things, because here this number is what we got from just some accounting mechanisms, and of course accounting cannot be perfect. It cannot account for everything, especially for things like ideas, for example, right? Because otherwise, if we just use balance sheet, many startups would probably just cost zero, because mm, they don't have so this my assets. They usually just have some idea there to develop. So of course this accounting stockholders equity cannot account for everything. So, and let's consider this was just some picture from the internet, and let's consider some uh, real examples. So can probably not here I can follow the link. So here was the first link was to the Sberbank of Russia financial statements, and here is really a lot of things. Where is its uh, balance sheet? So here you can see a statement of profit and loss. Here's this balance sheet, just called consolidated financial statement of financial position. And the important thing here is that depending on the company or depending on the resource, those points within uh, those detailizations may differ between companies, uh, between I don't know different portals, sources, and so on. But the general idea is the same. We have assets. We just name everything that they have in assets. They specify how much is the value of each of those, uh, you know, uh, types of assets, and the same for liabilities, and then shareholders' equity is calculated. So here, um, the last international reporting available is for uh, at least yesterday. It was for September 30th of the last year. So this is the end of the third quarter, which is the time to provide an accounting report. So here you can see that um, at this moment, total shareholders' equity of the Sberbank, it was around almost 5 billion uh, rubles. So, and if you have available something like Excel or something, you could calculate how much this would be in dollars and type it in the chat. Let's assume the dollar is, say, I don't know, 75 rubles. I can calculate it myself. So we have something in the chat. Yeah, it will be something like 65 million rubles. This is uh, this would be a dollar value of uh, shareholder equity from the balance sheet. And now uh, let's compare what we have here with what we have in reality. So market capitalization is a concept which represents the total value of all shares. So if we just take and calculate all shares and multiply this number by the share price, this is what we get is called market capitalization. And today, market capitalization of Sberbank is almost $82 billion. So as you see, it's different from what we saw in balance sheet. Of course, you could say that okay, it was for September at this is for today, but mm, no, this is not the reason. Just what we see in balance and what's going on in reality is not always coincide. And this is maybe uh, especially important, especially obvious for companies like Yandex. So here you can see the spoiler that Yandex market capitalization is around $24 billion for today. So please type in the chat your guesses. How do you think? What do you think approximate level of the shareholders' equity calculated from balance sheet from Yandex? So if you wanted to estimate Yandex, just recording every asset it has and every liability it has, and to make this cut for specific date today. How much do you think it could be? Just try to guess, maybe. So here for Sberbank, for example, balance sheet value was around 65 billion, and you see market it was around 82. So the difference was around 30%, maybe a little bit less. Uh, Sto, 100 million. We have one guess. Any other guesses? Okay, it's just a guessing game. So anyway, let's check. So we know that the total share price of all shares of Yandex would be, for today, it would be around 24 billion US dollars. And now here's something else in the chat. Uh, so another guess is 6.5 billion. So let's check what we had for the last available um, data. It's a long report. So you see, here is the balance sheet of Yandex, and you see it looks already different. It looks completely different. Not completely. The main structure is quite the same, but still, it looks a little bit different. So the last available data, as you see, the same as for Sberbank at the end of September. And please type in the chat if you can find here what is the value of shareholders' equity. So let's look at this column, because it's in US dollars, it would be easier to compare with this market capitalization. We have first guess. Yes, Ivan, exactly. Here you wait. Y37. I wonder what number did you use? Mistake. But it was so close that I didn't notice even. So here is total shareholders equity for the end of September of the last year. So the last available data, you see it's 4.3 billion US dollars. So, and compare now with its market value. Of course, the difference between Yandex balance sheet value and real market value is tremendous. For Sberbank, it's not such a big difference. We have something in the chat. And what number is more important, market capitalization or equity? Of course, I'm just think the short answer is market capitalization. So the more important is what you can buy and sell shares on the market. Because the real money are more important. But I'm just trying to come up maybe with some situation where stockholders' equity from the balance sheet may be more important. Mm. Usually, people rarely look at this. Sometimes they do, but not always. So my answer would be like absolutely market capitalization, because market capitalization is about real money and about the real, state of what's going on. And a balance sheet, it may not account for many other things which are not included in the current cut of the company's business. So actually, this shareholders value, shareholders equity calculated from the balance sheet, it's called book value of the company. And a little bit going forward, I'll just tell you here that analysts often look at price to book ratio. So this is basically the ratio of the market capitalization to the company's book value. So here it would be for Sberbank, it would be something like 65 over, vice versa, it would be 82 over 65 for Yandex. So it would be a little bit higher than 1. And for Yandex, it would be around 24 divided by how much it was, like 4.5 or something like this. So for Yandex, it would be much higher. So, and here you can see the current price to book value for Sberbank and for Yandex. And they are on very different level. Another important accounting report is called income statement or profit and loss statement, or just in short, P&L statement. P&L is a short for company's profit, by the way. So income statement in just reports the company's performance, the company financial performance over some period of time. It shows its revenues, its expenses, and final profits, and its utilization on some level. So here you can see example of the income statement, and yeah, so here we have a revenue of the company. Revenue is actually all money the company earned, not earned, but not it's all like how much money company earned, but before, before it accounted for all the costs, all the expenses. So in Russian it would be like выручка.
А доход как будет?
It would be either earnings or profits or something like this. So again, even in such formal things as accounting statements, there could be synonyms used. For example, instead of revenue, you could see here something like sales or net sales, or maybe revenues. For example, if you have a shop, uh, your revenue is basically how much you sold. So, and even if you don't have just a shop or maybe some much bigger company, still it could be written here like net sales or just sales or revenues. So synonyms are also possible. And what's for net profits, it could be called either profits, net earnings, earnings, and so on. And here you can see that going from up to down, step by step, different things are divided from the revenue. And here it's basically shown how mathematically we can come from revenue to the net earnings. So first, we need to divide cost of goods sold, right? Because when a shop uh, sell some goods, it does not make it out of nothing. Usually they are produced, so they are paid for, so they divided. So then depreciation and amortization, those are quite important concepts of depreciation and amortization. Actually, this is more or less the same thing, at least for us, definitely. But one example of amortization could be, for example, if you have some machinery, you have production company, you have some machinery, you bought one machine for production, and you know that its life term is about 10 years. And then every year you would have to amortize it, to make no surprises in 10 years, because otherwise you would have to just, uh, uh, you know, just account for its loss in 10 years, and it would have much bigger effect on the income statement. So to make it more smooth and predictable, amortization and depreciation are used. So of, of course, for income statement, again, as well as for balance sheet, there could be different types of how it may look like, how it may be detailed, uh, what what points are used here, what categories. But in general, the structure is the main idea of the structure is the same. So here we also have to do subtract interest. Interest is, for example, usually company hold some debt, not hold, but issued some debt or took a loan in the bank, and usually most companies, they have to pay interest payments regular. So it also should be accounted, of course, in the profit and loss statement. And the same for taxes. And after we subtracted everything, we got net earnings. So why is it important is probably quite intuitive, because when you analyze in the company, you're considering if you need to invest in this company or not. Of course, probably the main thing you could think of would be how much this company earns, how much this company earned, I don't know, 1 year ago. So here you can see some dynamics. How much it earned, I don't know, several years ago. Is there some positive dynamics? Is there some dynamics at all? So absolutely, you would hear a lot of references to the income statement. Either you look into it by yourself or you just read analytics. You would hear all those words uh, and reference to this statement all the time. So here I would like to introduce some more concepts. They are not always explicitly stated on the income statement, but they are definitely all the time calculated by some financial analysts, by researchers, and so on. So those are EBIT and EBITDA. That's exactly how they are pronounced. So EBIT stands for earning before interest and taxes. So here, if you would like to calculate this measure, it would be, you would have to take your net earnings and add back taxes and add back interest that you paid. And EBITDA is earnings before interest, taxes, depreciation, and amortization. So you would have to add back to earnings taxes, interest, and amortization and depreciation. And those metrics, they are widely used, and you will see it right away. So here, actually, you see that the picture was cut, and here even like additional information to the main income statement, EBITDA was calculated as well. So, example of the income statement. Let's go to the internet again. So, and consider, let's not, okay, let's start with considering Coca-Cola's income statement. So, how it may look like. You see here revenues, cost of goods sold. So this is income statement of Coca-Cola, the last one available. So here you can see the report over 3 months period and over 9 months period, probably from the beginning of, oh, no. So you starting for 3 months period. Let's concentrate just on this left column. And on the very left column with names. So you see revenues, cost of goods sold, again, selling, general, and administrative expenses. Exactly, we also have had this line in our example. Operating income. Operating income is usually, it's either equal or almost equal to the EBIT metric, usually. So, and finally, we would come to where's final net income? So income taxes, consolidated net income here. So here it is. Here is the most interesting line in this table. And consolidated net income is what is stated for, in our example, it was net earnings. So this is like a demonstration that it could be really, really different. It could be used in different names, in different companies and in different examples. So, but be careful. And now let's compare what we see here to what was reprinted on other sources on the very same company. So let's also choose here a quarterly report of the Coca-Cola. So it's already this. Okay. Oh, okay, here it is. Just as the last available statement on the website is for the end of September of 2020, we will also be looking at this column. So you see the total here, it's already called total revenue. It's the same number as we have here, 8,652. Of course, it's all in millions. So this total revenue of Coca-Cola is around $8 billion. Gross profit name is the same. So, but you see, you don't even have to go deep into details. You may just see it quite easily that names are a little bit different. So here is normalized income. Sorry. So probably you have to look here to get the income value. And let's compare with what we have in the official statement. consolidated income. Yeah, this is exactly the same number, but you see how different the names could be. So here on official Coca-Cola site, it's called consolidated net income, and here on Yahoo Finance, we just reprinting the company's financial statements. It's called net income common stockholders. And you see, Yahoo Finance is a portal which is used by financial analysts. And you see here, they already calculated those important measures as EBITDA and EBITDA. So they do this just every analyst could come here and take it already to use. So that actually looks like a lot of routine numbers and so, but and trust me, if you want to look into the company, you really need to think of it. However, I understand that it could be quite, quite boring, but still, it's extremely important. So maybe uh, it's a good idea to learn about it a little bit. So the last statement would be cash flow statement. We would not concentrate on this so much as on the previous ones. Cash flow statements provides some data about how much cash came to company, like in real flows, and how much cash was paid. And the question is, um, okay, let's consider one real example and then move further. This is, by the way, the same file that we just opened. So here the balance sheet that we looked into. And here you see the consolidated statement of profit and loss. Sorry, profit and loss we don't need. We need cash flow statement, right? So here, interim consolidated statement of cash flows. So here just a lot of lines representing some type of cash flow, like I don't know, fees and commissions received, interest expenses paid, and so on. And this is not the end of the table, probably, right? So this is not the end of the table. Here, a lot of cash flow from investing activities, etc., etc. So, of course, for now, we do not need to understand every line here. But now let's look at this part. So you see that net increase in cash and cash equivalents is effectively a net cash flow that was received by the company. So for 2020, it was 312 billion rubles, I guess, or million rubles. Let's check the scale. Yeah, I believe it's it all in billion rubles. Not bad for the company just to have 300 billions in cash and cash equivalents. So the question to you would be, I understand it's a lot of details. It may be not so clear for now, but just in case, if someone feels like you understand this on at least on the concept level, please could you share ideas? Why do we need cash flow statement if we already have income statement? So we already know what income we made. Why do we care about how many cash flows came to our company? So how is it different? So the spoiler is it is different. The question is why. So isn't the question is isn't how much we earned is the same thing as how much money came to the company as a real cash flow?
Yes, it's different because maybe time moments are not like, it's not one time moment, they are different. So we have to recalculate cost of the money probably.
Mm, if I understood what you meant correctly, that yes, the idea is probably correct. If I understood you correctly, so let's consider the example that we are, I don't know, we are private university, and we just made a contract with, I don't know, 100 students in the beginning of the year. So and those students are gonna pay us money, right? Of course, we can already we have an agreement, so we have I don't know, we made a deal already and it's profitable to us, and we can account for it on our balance sheet, sorry, on balance sheet and on income statement, etc. But the payments, as you understand, as we are the private university, student would make payments all over the year. So the cash flows would come not in the moment that we made a deal and fixed our earnings and profits, but cash flow may come different from what the profits was fixed. Another example could be, I don't know, we just got as a price or as a payment, we just got a building, for example. So building could be recorded as a new asset. It could be uh, calculated in net income, probably. Oh, sorry, probably it's a bad example. As always, accounting has a lot of nuances. Probably building cannot be calculated like this, but still we could get some intangible like thing, and we would calculate it as income, but it would not be cash, something like this. So cash flow statement and income statement is not the same thing. And as well, for example, if we imagine some startup, for example, startup usually attract money and uh, they do not generate cash flows right in the end of the project. But it may be the case that uh, startup already generates some value. It could be reflected in the income statement, but real money would be made later. So let's move further. And we talked about financial statements. They're important. You will have to look into them. But after you do, you may be aware of such thing as ratios. Ratios or financial ratios, uh, those are just some ratios of some values taken from financial statement and like matched together. So this is really important, I think, in all company analysis. You will see it right away. But let's start with example of ratio. It's called price to earnings ratio. Probably you heard of it. Some of you, at least, I believe, heard of price to earning ratio. It's mentioned in media quite often. And price to earning ratio is just company's current share price divided to its uh, current earning per share. So mathematically, it's quite simple. So you just divide price to earnings, and but what it can be, why can be can be interesting. First of all, high price to earning could mean that a company stock is either overvalued. So let me draw it. So we just took price from exchange trades and divided it to earnings. And if it's too high, I don't know. If it's too high, it may be for two reasons. Either earnings are small or price is big. So, and if price is big and the earnings are small, um, it may indicate that price is not exactly adequate. Because why would a company cost a lot of money if it earns nothing? This is a reasonable question, but on the other hand, it could be the case that investors just believe in this company so much. And for example, when it's just some startup like Uber, for example, in the beginning it does not generate any profit, but still it may be high in price. And then late in future, investors are hoping that the company will start generating some earnings, and so the company will grow and they will get some reward for this. The shortcoming of this ratio could be that uh, that companies with negative or zero earnings, they cannot be discussed in terms of this ratio. And it's not always like if the company earned nothing, then you know then this company is doing bad this year. So, and here is quite a popular example recently discussed. Probably you heard the question discussed is Tesla stock overvalued? Many analysts, many investors, they're arguing that Tesla stock is too high in price. This is inadequate. This is a bubble, etc., etc. And let's now discuss why they think so. So, current price to earning ratio of Tesla is almost 1,700 as for yesterday. So, uh, what does it mean? So it doesn't make sense just to look at this ratio, because what's overvalued? Overvalued relative to what? So probably it makes sense to compare this company ratio, price to earning ratio, to other companies from the same industry. So um, here from the right, you can see other examples of other company. For example, for automobile producers, you see it's like the price to earning ratio is currently for General Motors it's less than 25, for Toyota it's less than 16, and for Bayerisch Motoren, it's a German, I believe German automobile producer, is less than 14. So you see the level of numbers, it's not comparable, not even close comparable to Tesla price to earning ratio. So it's like 1,000, not 1,000, 100 times less than what we have for Tesla. So of course, um, I'm not making any specific conclusions. I just want to tell you why many analysts, why many investors, they argue that Tesla stock are overvalued, overpriced, and this current price that investors pay for Tesla is really really too much. So that's why, because on average in industry, this price to earning ratio is completely different. Some also argue that Tesla cannot be considered just as a regular automobile producer, and this is probably true because they are special. They have technologies. They they're different from the classical automobile producers. But if we can compare them with tech companies, so you see price to earning ratios, they are higher than for automobile producers, but still uh, they cannot be compared with Tesla price to earning ratio. Uh, so what else to say here? And also here you could pay attention then for different sectors, ratios level can be different. So it probably doesn't make sense to compare Nvidia with automobile companies because you could think that Nvidia is overpriced when actually for tech companies, okay, level of price to earning, okay. Next ratio would be ROI or return on equity. I'll just tell you definition and later we will see uh, how it may look like. So return on equity is just how much profit is generated for each dollar of shareholders' common equity. So just you need to take net income and divide it to the size of the amount of shareholders' equity. So it's a little bit more complicated than it looks at the first sight because when you start accounting for the correct value of this average shareholders' equity, it will be quite complicated because you don't need to account for this, you need to account for this. But usually when you analyze companies, everything is already calculated for you in the right way. You just need to know that return on equity is, in general, is how much each unit of shareholder um, equity value is earning uh, in terms of rate of return, and just use it when you see it in analytics. Um, Another measure would be EV to EBITDA. EV stays for enterprise value, and mm, is, if saying simple, then enterprise value is some kind of analog of market capitalization, but um, in spite of but enterprise value, it's not accounting for companies' debt. So uh, there are also different nuances, but the main idea is that enterprise value is a measure. It's like market capitalization, but without accounting for the company's debt. Why it can be interesting? Because um, assume you have I don't know, some automobile production company. Probably this is not the best scheme to draw, but let's assume it will go some production. And you have some business model, you have people, you have infrastructure, you have experience, you have buildings and so on, and you just want to know not what is the current price of your company and how much this business model costs, how much your infrastructure costs, how much um, this little country which you made while building your business, how much is this. But it may be the case that, for example, to finance all this business, you took a loan in a bank. It may be the case that you took a loan in a bank and now you have to pay interest back. And interest, it can be really huge compared to the company's business. And of course, when the market estimate this company, the market would probably be accounting for those loans payments as well. So um, just to estimate how the business model works by itself without thinking of how it was financed and so on, uh, enterprise value can be used. So if to be very very simple, enterprise value is current market price of the company, but without accounting for all the loan payments and without thinking of um, what were the financing sources of this company. So in general, this enterprise value or EV, it's aiming to estimate the company nature and company's business by itself. And one example of using this value of EV could be a ratio of EV to EBITDA, and uh, it can be seen as comparing how much company uh, costs, not how much company's true value, the company's natural value is, and how much more it is than what company earns. And why EBITDA? Because EBITDA, it's not accounting for such thing as depreciation and amortization, and they could be quite artificial. So depreciation and amortization is not real money that we're getting. Taxes as well are not important here because taxes. Um, okay, never mind. Because taxes, they do not have anything to do with how much company earns, right? Uh, it doesn't have anything to do with the business model and so on. So, and as we will see, this metric, it may be quite popular for analyzing companies. Another ratio could be debt to equity. Debt to equity is also quite important ratio, and It just indicates the relative proportion of the shareholders' equity and debt, which was used to finance the company assets. So it can also, you see how I wrote here that it also can estimate how much leverage the company is using. What does it mean? Let me draw it for you. So let's imagine that we are looking at company's balance sheet. So as we just discussed here, we would have assets. Here we would have liabilities. And within the liabilities part, we would have to it can be seen as a shareholders' equity, but sometimes it's just seen as, we can make it like this. So this would be company capital. So this is what company owns. This was company owe to someone. And what is left, it can be also referred as company capital. And how can we see it? Remember when we discussed it on the very first class, we said that if the company needs money, it has two major ways to attract financing. It could either issue shares and get money for this, or it could issue debt instrument and get money for this again. When the company grows, it will probably have one part of its capital which was raised as debt financing and another part of its capital which was probably raised as just a division of shareholders' equity to other people. So it was just, raised by issuing shares. So let me choose different color. So now let's consider an example where company financed all its businesses with shares without debt. So here we're not considering anymore. Let's assume that all company's capital initially was financed by issuing shares. Then its balance sheet would look something like this, right? So here is only shares. Here are assets, liabilities. Let's now assume that something happened to the company, and for example, I don't know, one huge office of the company was ruined. I don't know, something happened, earthquake or some other condition worsened, and the company just lost part of its assets. How then the new balance sheet of this company would look like? So amount of assets would decrease, amount of liabilities would stay the same, and you see what is left would be really, really small. So this is a simplification, but in this case, at least the book value of the company, book value of the share price would really, really shrink, and company's capital would become much lower. But when we finance with shares, it's not real problem, okay, it is a problem, but it's not like a survival problem. Why? Because shareholders, they own in the company. They must be ready that everything will be bad. They got no promises, so we do not. If we are a company, we do not promise shareholders that the share price will be up forever. So if this happens, so we don't need to pay any additional payments to the shareholders. But the problem would be completely different and much bigger if uh, the company would have huge amount of debt. Let's assume that here green uh, green square, this is debt, and debt cannot shrink because debt is a predictable fixed payment. And you see here we essentially have no place, to put this debt in. So what does it mean? It means that our liabilities would be higher than company's assets. This would mean default because the company would not be able to fulfill its obligations to pay its debt. It's very simplified now, but in general, you see that if something happened, the company does not have this safety pillow to avoid the shrinking of the company's capital. And if we hold that, it is fixed. It assumes fixed payments, and it does not shrink. And in this case, if the company has too much debt, it would have problems if something bad happens. So, and this ratio is sometimes called leverage. You see, and if it was debt, the higher the debt is, the lower shrinking of asset needed to make it all very bad when we don't have money to pay for the debt. So, any questions? No questions. Another ratio is called coverage or interest rate coverage. As I said, most companies, they have some debt instruments or they have bank loans. So important thing for investors could be that is company how company can cover its obligations to pay interest payments. And here could be one example. So EBIT, it's earning before interest and taxes over interest expense. Why it makes sense to use EBIT here? Because obviously interest paid before it's subtracted. So interest will be paid exactly from this amount. Quite a tricky, complicated question, but just in case, I'll check, maybe someone can answer. Do you think if you're a bank, or if you're considering to invest in a bank, do you think it makes sense to calculate this ratio for a bank or for some financial company? I'm not sure that you will answer this question, but just in case, I'll wait for 15 seconds for you to answer. Okay, I guess it was quite a tricky question, but the answer is that um, we usually use ratios to analyze how a company is performing. And in this case, interest expenses for most companies, this is some unpleasant obligation that they need to make. But for bank, the problem is that for bank, paying interest for some, for example, term deposits or some other instruments, it's a nature of their business. So we would just see probably that interest coverage ratio is like tremendously awful for banks, but this is not because their business is bad. This is because interest expenses is a core part of the bank's business. Why I'm telling you this example, just to estimate that ratios, they can be different for different sectors of business, and they should not be uh, just applied to everything randomly. For different sectors, there could be different ratios more reasonable to use. So we just discussed all definitions that I wanted to discuss with you, and now let's consider uh, one example. If I Google, for example, let's look into Yandex, and I'll just go to some website, and here what I will see. So you see, this is a website for analytics, and you see they already collected all main measures, values, and ratios here. So here we can see revenue. This is from income statement. So dividends. Here market capitalization, or market cap in short. PS ratio, actually. This is probably price to sales or something like this. You see many ratios possible. Probably this is price to sales, but I'm not sure. PE ratio, this is the one we just discussed. Price to earning ratio, it's quite. Why is it so? Yeah, that's right. That's okay. I thought it's too high, but no. Price to earning ratio of Yandex is almost 70. This is quite average for this for the tech companies, I guess. Price to book value. Remember, book value, we also discuss price to book value, and we see it's almost 6. Beta, we don't need to care about it. Debt to equity ratio, so our company leverage. You remember yesterday I wrote you in the chat, and yesterday we discussed that if Yandex has any credit rating. And later I looked into it, and it turned out that many IT companies, they prefer not to have any rating, because a rating, it usually matters when you have a lot of debt. When you're interested to attract more and more investors to buy your debt, then you would probably need some external company to estimate you and to make a credit rating for you. But in case of Yandex, you see the debt to equity, it's not this big, so debt is substantially less than equity. And to be more specific, I heard that the debt that Yandex issuing, it's not exactly classical debt, it's also convertible to shares and so on. So you see, the debt leverage of Yandex, it's quite small. So that could be one of possible reasons why they don't need credit rating. Free cash flow and return on equity, or you remember this was a short name of ROE. ROE of Yandex is a little bit less than 11%. So this is just a simple example. Then when you just started to be interested in some analytics, you'll just come to the first website and you will see a lot of financial ratios. So it's better not to neglect them, because you'll definitely face them if you will be following the market and read market analytics. So to sum it up, you see that there are a lot of financial ratios. We just mentioned few of them. There may be different more, whatever you come up with. Ratios usually used to estimate companies' performance and companies' safety. It could be used, different ratios, they could be used to compare companies with each other. As we looked for Tesla, for example, you see that its ratio of price to earnings was much higher than for other companies from the same sector. And in different sectors, it may be reasonable to consider different ratios, because sometimes, just because of the nature of some specifics of the business in specific field, it may be the case that it may affect the ratio, and it would be not reasonable to compare company from different fields, because just because of nature of their business, it may be the case that they will not be comparable at all. As we saw, I hope I convinced you that ratios are widely used in stock analytics. So Do not neglect them. And that's probably it on ratios. But we're not forgetting about them. We will continue talking about them as well. So, company evaluation. Finally, um, how to value the company? It's a tricky question, as we said, and we need to we need to if not the price the company, not to evaluate the company, at least we need to understand if it's overpriced or underpriced, right? Because we want to invest, we want to know if in long term the company price will go up or it will go down or whatever. So as a disclosure would be that company evaluation, it's again, it's a separate in finance. Company evaluation, it's a separate field. So there are people who just working on company evaluations, and that it. Why so? Because there are a lot of nuances, a lot of details, a lot of complications, and um, it's probably good to know what types of company evaluation exist, but no way you can repeat it at home and you know, probably to try to estimate the exact company's value by yourself, it's unrealistic, uh, and even for professionals it's very time consuming. So let's consider four major types of company evaluation. We will start with book value. Book value is sometimes even excluded from this from the discussion of company evaluation, because everyone understands that this is just not this could not be used as a real company value. We just discussed book value, but I'll remind you. If we just write down everything that company owns, its assets, and everything that it has to pay, it owes to someone, then whatever left we have, it may be called it may be called some way capital, it may be called shareholders equity, but from the company value point of view, it may be called book value. So if we just take a cut of the company and look what it has and what it owes right now, the difference of those two values would be called a book value. And uh, yeah, it's possible way to estimate the company business, to say that company's value is just a difference between assets and liabilities. But as we saw, it may be not the same. For example, for Yandex, we saw that uh, price to book ratio was like almost 6. So usually it doesn't mean much, but you need to know that it exists. Multiples, I believe, is one of the um, reliable is not a good word, but definitely one of the most used ways to evaluate the company. What does it mean? Multiples in approach which is based on using different ratios and comparing them with the industry average. How it may look like. For example, I don't know. We know that, for example, we consider, I don't know, metal producers. We consider a sector of metal production, and we know that sector average price to earning, I don't know, it's about maybe 20, say. And here is the company, the new company, I don't know, company X. And we know that its current market price is, for example, um, I don't know, 100, and its earning per share, I'll just write it like E, but you need to remember that when you divide one over another, you need to act either in terms of market capitalization and total earnings, or you can just use price of one share and divide it over the earning per share. But the logic is quite the same. So, and earning per share, for example, it's, I don't know, 10. The question to you: how do you think company X it's overvalued or undervalued or adequately valued according to this approach? I did not exactly explain it yet, but maybe you already got the idea. So, how do you think if on average we have in this sector price to earning of 20 and we have price per share for company X of 100 and earnings of company X of 10? Is it overvalued or undervalued? Please type in the chat. What do you think? Or many variants in the chat. Yeah, it's definitely it's undervalued probably um, because its price to earnings ratio is 10. And it's much lower than at least twice lower than industry average. So we would expect it over the time. We would expect it long term and come up to industry average. So the price would need to grow twice, and using multiple approach, we would estimate the long term company's prices 200. But this is of course I'm quite skeptical about some exact true value of the company, but at least we could understand that, for example, it's significantly undervalued. Um, Discounted cash flow model. A discounted cash flow model is a quite also quite popular approach. I believe that if you know in Skoltech, as we know, there are many people attempting to make their startups, and when people attempting to make a startup, they usually need to you know to attract financing, and when people try to attract financing, they need to uh, you know to somehow evaluate the company first. And usually, when startups try to evaluate themselves, um, I think this is probably the most common approach used, because for startups we cannot use, for example, price to earnings or some other ratios, because startups are not traded on exchange, for example, on the market. But discounted cash flow, this is a different approach. It assumes that you build a financial model of the company, and you uh, just like look into future, predict what cash flows would be generated by the company, not earnings, but cash flows. Remember, these are different things. And you just calculate their present value. So it would look like this. Assume that you have a company and you have some long-term project, and um, you just made in a very, very, very huge Excel file, you made a company's model, and you know that uh, for example, starting from year, I don't know, starting from year 2, your company will bring you some income, and this income, for example, it will be growing 10% each year. And so on and so forth. And that's how it would be work until perpetuity. And then you would have to, just discount all those future payments um, to the current moment of time, and as a result of this you would get the company's value, or DCF value. So it's probably hard to say that this estimate would be, I don't know, exact, or it would be true value of the company. Probably not, but at least you would have at least some understanding of level of the company price in general. But again, even if you have your own company, probably you would not be able to do it by yourself, and you would have to ask other people to build this model for you, because this is not an easy task. Even so, the general scheme and general idea is very, very simple. The last approach could be via dividends, because as you remember when we discussed that there are two main reasons to hold stocks. One, people would expect the stocks to grow in price, and other investors, they would expect to get high dividends, and this is another approach to estimate company value from the point of view of investors who want to get dividends. So this is just some screenshot from the internet. Sometimes it's called a dividend discount model, sometimes it's called Gordon growth model. But what it's like, assume you just bought a stock and you bought it because you are willing to receive dividends and you just want to hold the stock like forever. And companies, they usually announce their dividends a little bit in advance. And even if they don't, it's more or less possible to estimate those dividends uh, right away. So via dividends, you could estimate your company value, something like this. You would just have to discount all future dividend payments you are going to receive. And you have to discount it, as always, over some discount rate. Assume that we know the discount rate. Here on this screenshot, it's called constant cost of equity capital. But essentially, this is an interest rate of raising some financing. We will not go deep into these details, but constant cost of equity capital, it would be the same as what if we were willing to attract financing, issuing debt, for example, etc. By the way, okay, we will probably make a break soon. So we would account for the first dividend payment, then we would account for the second dividend payment, the third dividend payment, etc., etc., and just sum it up to perpetuity. Of course, you could say dividends cannot be the same every year, and that's true. And usually, some assumption is made about the dividend growth rate. So it would be something like this. For example, we assume that dividends will grow on rate G every year. And in this case, mathematical expression would be like this. And you see again, this is a geometric progression. And if we sum it up, we will get something like this, where D are dividends. So that's it for company evaluation. Again, you probably will not have to calculate all of this by yourself. But it's a good thing to know all the things, just in case that you're reading some analytics, or you reading some research and there is some justification of why, for example, this specific investment analyst thinks that this company is overvalued or undervalued, and those are the approaches that he or she may offer you to justify his or her arguments. So how to choose the stock? It was a popular question, by the way, in the Google form that I posted in the Telegram chat. So how to choose stock for your portfolio? Once again, there could be no universal advice, but first of all, think of what is more comfortable for you. You may choose stocks which you expect to grow in price, or you may choose stocks which may not grow in price so much, but it may pay high dividends, for example. Usually, you may find this information just on some forecasts, on some research, on some portals. So it requires some research to understand if it's a growth company or if it's dividend paying company. It may be both, but still sometimes it's more or less clear that this company will have stable dividend politics, and this company, has no specific dividend policy yet, but it will probably grow in price. So it may be a combination of two things, etc. Read analytics and research. Um, this is indeed a universal advice if you want to invest in shares by yourself. There are different portals, different opinions, different justification. You'll probably need to read all of them and just decide which of analytics and forecasts and research you believe most. And here I also added the point of consider paid subscriptions. Why that? Because I guess literally on every portal, on every business media, or every business, I don't know, every broker, every bank, they all provide you with some free investment ideas. Uh, why they are free? Because usually they are simple and they do not require much. And usually it may look like, I don't know, sorry, invest in Apple just because Apple is going to grow, invest in Apple. But to understand why, to achieve better understanding of this suggestion, you would probably need more details. And often there are some paid subscriptions, sometimes at exactly the same entities, sometimes on some third parties. You can just buy a subscription to get an analytics from this paid subscription, and could provide you with much more details, and with much deeper analytics, and with much deeper details. So when you are interested in some particular sector, uh, you probably need to learn more about the sector and compare uh, companies with each other. As how to do this, first of all, again, reading analytics, looking at financial ratios, looking at performance history, etc. And here just one specific point, that in general it considered that consumer company, they are usually doing better through some crises. For example, if this is a food retail company, people uh, will always need food, people will always buy food. So this company has probably less chances to go bankrupt than, I don't know, uh, some high technology producing company or some cosmetics producing company. So when there are consumer goods, they generally consider that they are more protected from crisis. But on the other hand, people will never probably need 10 times more food than they do. So potential growth is limited as well. Just I know I find this point useful, so I decided to tell you. So, and this is, by the way, one example from exactly the paid analytics, but I find this analysis is quite deeper. It's deeper than what you usually can see for free or just on some public websites. And this compared Russian metal producers. Don't If you do not understand Russian, don't be scared that names are in Russian. I don't know all these names by myself, maybe with some exception. But um, what interesting here is approach. So you see that on this graph we have two axes. The vertical axis is debt to EBITDA ratio, and the horizontal axis is EV to EBITDA, so enterprise value to EBITDA. And mm, the question to you, if you want to invest in company, do you want this company? Let's start with EV to EBITDA. If you consider some company to invest, would you be willing to have high EV to EBITDA, or you would be willing to have low EV to EBITDA ratio? And I can remind you that EV or enterprise value, it's the same, it's similar to market capitalization, but it's just not accounting um, for companies' debt. So you may also consider it something similar to my market capitalization divided over EBITDA. And EBITDA is some adjusted type of earnings. So please type in the chat, what would you choose for investing? Would you prefer a company you're investing in to have high EV to EBITDA or a low EV to EBITDA? I understand that those ratios may be, it's not enough just to read the definition to start using them. Why are the radiuses different? The radiuses just represent the market capitalization of each company. So you may even probably notice that the higher the rounds, the more familiar are the names. So this is just the size of the company. Nadezhda assumes it's high. Valentina assumes it's low. Okay, good that we have at least some suggestions. Don't worry if you do not if you try to understand but you still do not understand how those ratios are working, then it's okay. It takes some time. So while reading analytics, etc., you'll get better in understanding this. So EV to EBITDA, I would say the low is better for the investing. Why is that? Because enterprise value, enterprise value, it's derived from market capitalization. So it's proportional or somehow proportional to price, to the company value. And EBITDA, it may have its own value of calculation, but sometimes, somehow you may say that its nature, it's relative to company earnings, right? So probably if I invest in company, I would prefer it to have low price, so I would not have to pay much for it, and at the same time, I would prefer it to have high earnings, because the higher the earnings, the probably better the company's future perspective. So the company well-being, I would say, is growing in this direction, at least on this axis. And what would you answer to the same question about the debt to EBITDA ratio? What would you be feeling your company debt to EBITDA be? So you would invest it. Would you prefer a low debt to EBITDA, or you would prefer a high debt to EBITDA ratio? Please type something in the chat. What is better for the company, to have high debt to EBITDA or to have low debt to EBITDA? Yeah, low, close to zero. Yeah, this would be perfect. Zero would be just perfect, I believe. So of course, when we consider in some company, we would be, if we have a company, we would probably prefer its debt to be as low as possible, because having a debt, it's not good for a company, right? So we probably just prefer as low debt as possible, and as for EBITDA, the higher it is, the possible. The higher it is, the better for the company. So value of the company here grows in this direction. So probably according to the Alyonka Capital analysis of metal producers of Russia, we would say, so according to this picture, this company would be just perfect for for investing. But this is just according to this analysis, so it's not some universal advice. In Russian, it's can be read as ЧМК. I'm not even sure what it means, but anyway, it doesn't really matter um, to understand, to demonstrate this approach analysis. That's probably something like uh, Chelyabinsk Metal Company or something like this. Any questions on this plot, on this graph, or on this topic at all? Okay. Anyway, if you have questions later, please interrupt me and we will come back. So this is just some statistics from Moscow Exchange. Moscow Exchange also, as well as Bank of Russia, recently they issued some statistics on individual investors and their holdings. And here from the right, you can see Russian companies. Sorry for Russian, this was just the only data available, but I'll read it out loud. This is Gazprom, Lukoil, those are oil and gas companies, and Nornickel, metal producer, Sberbank, and pay attention. So here is Sberbank common shares, and here is Sberbank preferred shares. So they're both quite popular. Aeroflot, Aeroflot is a Russian Airlines. Mail.ru Group, we discussed it yesterday, and some other oil and gas company, and mobile operator, and VTB. VTB is Russian bank as well. And from the left, you can see what Russian investor prefer for foreign stocks. So, of course, here the statistic is made probably only from the stocks which were available for Moscow Exchange, but still it can be easier. So Alibaba Group is the most popular holding of Russian investor Moscow Exchange. Alibaba Group, you know, this is the owner of AliExpress. Pfizer, interesting. Mm. So during the coronavirus pandemic, everyone started to believe in vaccine producers. Apple, Tesla. Tesla is also quite popular recently. It's growing really, really rapidly, as we saw. Intel, Boeing, Amazon, Nvidia. This is AT&T. Do you know what this company is? AT&T, what is it? I don't know. So if you know what this company, please type it in the chat. And American Airlines. So that's it for stocks. Do you have any questions on this area? Okay, if you have no questions, then let's continue. Let's continue after the break, and let's make a break for 10 minutes so it will be in time to discuss everything. There is not this much left, but still, just in case, let's make break till 11:50. So I hope everyone is back from the break, or at least you can hear me. And let's continue to the next topic of indices. It's a really short one, but before that, uh, I want to ask you about one thing. First of all, um, please, for those, as you remember, tomorrow we are gonna listen to student presentation on different financial topics, and I want to ask you to fill in the table if you did not yet. So I see, uh, at least this morning, I saw that teams, uh, at least for two teams, we still don't have. I still don't see the topic in the table. There's a team number 10 and team number 6. So please fill in the table. And another thing I want to ask you is something in the chat. Okay, thank you. Um, so for tomorrow, we are going to have 14 presentations, and mathematically, it seems like it's going to be really, really very tense in time, and it would be just 10 minutes for every presentation with some short, really time to ask questions and to make a break. So I wanted to ask you to start maybe a little bit earlier, maybe uh, at 10, sorry, at 9:30, and just in case if I'll try to to manage the time as well as I can. Uh, so I'll also ask you to please make it try to make it all within the time limits, and I'll try to follow the time as well as I as well as I can. So if we finish earlier, we will just go from earlier. Um, and if you have some problems with this, for example, I don't know, you have some doctor appointment and so uh, maybe it's better to pre-record presentation. Uh, I think it would be an option to after record presentation, just um, because sometimes maybe someone would be willing to interrupt or something like this. So um, maybe if you don't have time, maybe uh, I'll ask someone to record it and send me later, but I hope it will not be the case, so we could have at least some discussion. And if you have troubles with this time, so please let me know, and it's okay. Or maybe you could just disconnect earlier if you need. I'm just worried that if we have some lag in time, that maybe some people who have classes after our class that maybe, for example, have no time to have lunch or something like this. So this is uh, my question. Usually show recording and then have a discussion. If you want, you can do this. So you may have a recording if you want. I'm just not sure if this would be an option for everybody. But of course, if you have a recording ready, then you can pause it even if someone has a question. So it's not such a big difference. I'm just afraid that it would be um, additional load to people, to make a recording and then, okay, no one controls the time and then to record again and again. And if we do it here in classes, then probably I'll comment, for example, that you have 4 minutes left and so on. So I understand if you want to sleep a little bit more or something like this, please let me know if you won't be able to do this. I think some people will still be able to do this and maybe some, disconnect earlier then. So still, we will have something going on in the class, I hope. So I'll also send this in the chat later. So indices. What are indices? So stock indices. There are not only stock indices, there are other indices as well. And what is stock index? Stock index is a market index or um, Yeah, usually it's called market index or some industrial index or some sector index. And this is an index that measures a stock market or some sector, or it represents several companies on the market. It usually computed from the price of selected stocks. For example, it could be just a mean price of these companies, or it could be some weighted average of this price, and it could be weighted, for example, with capitalization. It could be weighted with company price itself. So stock index is essentially you just pick up several companies you're interested in, and you just weight their price and calculate some average. And why do we need stock indices? Because it makes easier to follow and to measure performance of the overall market. And it make it easier to understand what's going on in the market in general. So you don't need to check every company separately. You may just Google uh, stock index, look into stock index, and understand what is the market condition right now. There are not only stock indices, there are also bond indexes, commodity indices, currency indices, but stock indices are probably the most well known. Question to you is please type in the chat or say it with your microphone. You probably heard of some indices, and if you did, please tell me what indices do you know? What stock indices do you know? And the hope that I know them too. But if I don't, I will be curious. So do you know any stock indices? And what are they? S&P 500, yeah, probably the most well-known index in the world. Nasdaq, by Nasdaq, probably you mean Nasdaq Composite. Ah, yeah, Nasdaq index, yeah, I see. Yeah, we will, index of Moscow Exchange. Yeah, there is index of Moscow Exchange as well. So, yeah, and here you probably see all those indexes that you just mentioned. So S&P 500. So here we just discussed the most famous indices of the world. S&P 500 is definitely the most well-known famous indices. It just represent 500 largest US companies by market capitalization. Um, so it's company like Apple, Facebook, Twitter, etc. So just this index just takes 500 largest companies, weight them by their capitalization, and compounds together. Another quite famous index is Dow Jones Industrial Average. It takes it consists of 30 large companies from different sectors, usually industrial, and it weighted by price. So this is usually considered a shortcoming of the index because you weight price by prices, so it's a little bit weird. So it's like double accounting for pricing. But why is it so? Because this index, as I understand, is quite old and just historically happened so that it was weighted with price and then it became popular and we still have it. And as many analysts and people follow this index, it's hard to change. It's hard to change it because many things are tied on the current methodology. Nasdaq Composite, which was I believe mentioned in the chat, is a Nasdaq is name of exchange. Usually, it's associated with high-tech companies, and so Nasdaq Composite is an index of high-tech companies listed on this particular exchange. FTSE 100 is an index of 100 largest companies of the United Kingdom, so somehow similar to S&P 500, but just on the UK market. Nikkei 225, Nikkei 225 is a list or index of 225 largest company traded of Tokyo Exchange. So it's not necessarily Japanese companies. These are just companies which are traded on Tokyo Exchange. Tokyo Exchange is also one of the largest exchanges in the world. SSE Composite or Shanghai Composite is index of stocks trade on Shanghai exchange. I don't remember how many of them are there, but Shanghai Composite is also quite popular index to look at. And MOX is a Russian Moscow Exchange index. Its index is nominated in rubles, and this is an index of companies traded on Moscow Exchange. And also another Russian analog, RTS. It's index of stocks on Moscow Exchange, but it's in US dollars. So I believe all companies that we mentioned in the chart are there. So here is the index of Moscow Exchange, Nasdaq Composite, S&P 500. So one example why index can be useful. So as we said, index can be useful to follow all market in total without following each company separately. And usually the stock and dynamics, it reflects some major events. And here you can see the historical price with a quite bad resolution in years, but still you can estimate. What do you think those two dramatic market crashes of S&P 500 index? So you see the market price dynamics, and you see that here we observe two like really rapid drops of the market. What do you think those events were? Something in the chat. Depression crisis. Yeah, that's right. Here, it's probably not probably, but almost definitely, it's a Great Depression in the United States in 1930s, in the beginning of 1930s. It was a Great Depression, a severe economic crisis in the US, and here this is the index of US companies, so of course it suffered. And here the economic crisis of 2008, and again market crash. In the chat, dot-com bubble. Dot-com bubble actually, if it were here, it would be probably somewhere here. Dot-com bubble we would see definitely if we just looked at Nasdaq Composite Index. Because, and as I remember when we discussed it yesterday, there were a graph of Nasdaq Composite. You remember it was rapid growth and then rapid drop. So because tech companies, they were more involved in all this. But probably maybe somewhere here, maybe it's reflected as well. So this is just another time period. And as you see, recently we also had a market drop. It was quite substantial, more than how many percent? It was around 20%, I believe, in short period of time. And you know, the question is what happened in 2020? Of course, the answer is quite obvious. This was a coronavirus pandemic, so that's why we experienced some market crashes this year. So that's basically it for indices. I did not put index dynamics here on graphs because, you know, in general, they're all more or less similar, and you just need to know that they exist. And just if you're interested in some particular market, you may just look into some index. So here is a list of major indices, and here how can they reflect the respective market they are tied to. So any questions on indices? Okay, no question today. Funds. We already discussed that the fund could be a good alternative to investing in stock because sometimes to invest in stock you need to do a lot of stuff and a lot of market research, and it could be quite time consuming. Sometimes it may be an easier way just to choose a fund. And funds, they usually already have some strategy, and so you know where you invest into and what the strategy would be. You just don't need to, you know, to spend your time on performing it. So Just as a reminder, this is a slide from the very first class when we discussed financial system. Mutual fund is a professionally managed company which has its own strategy. It has only one big portfolio with only one strategy, and so all people who invest in a mutual fund, they'll just buy some small share of this fund's portfolio. So all money are pooled and all invested in the same portfolio with the same strategy. And exchange traded funds is exactly the same as mutual fund, with only a major difference that exchange traded funds, they are traded on exchange, as you can get it from their name. And the short from this would be ETF. So, I'll remind you an example we already discussed. So, for example, you want to invest in 500 biggest US companies simultaneously. Of course, it would be really hard, time consuming, to press on all buttons, to follow the market. Maybe, the rating changed and the company which were, I don't know, number 500 yesterday, today it's 501, etc., etc. So it's quite inconvenient to maintain such strategy by yourself. So by instead, you can go to the broker and buy ETF that provides you an opportunity to invest in S&P 500 index. And this, as you remember, S&P 500 is an index of 500 biggest US companies. So there are already special funds, and their main strategy would be just investing in the S&P 500 indices and just following. So they just make portfolio which consists of exactly the same shares which are included in the S&P 500. They're rebalancing those portfolios as soon as something changed in the index. So things that are hard to do by yourself. So funds. What types of funds could be by types of assets? For as we saw in examples, there could be index fund, and so it makes index not just some abstract measure, but also you could invest in index, and this is very convenient that such funds exist. Also, there could be some just actively managed funds with smart strategies. Those smart strategies, they may be secret, they may be open, but still, the main idea is that there could be just some funds that may just some special strategy. And if you like the strategy or you like their performance record, you may choose to invest in them. Commodity fund, the funds which invest in some commodities like oil or, I don't know, gold, etc. Currency fund, for example, fund which invests at the same time in a very diversified currency basket. For example, euro, euro, US dollar, Swiss franc, Japanese yen. I know many currencies in one basket. Sector fund, for example, some metal producers index or something like this, or just only, I don't know, Russian IT companies or something like this. So different types of funds are possible, different strategies, different underlying assets, different portfolios. So here you can see the list of the largest ETFs of the world. You see that top probably almost all, maybe not, but definitely most of those funds, they are tied to some index. So you see that most popular indices, number 1, 2, and 4 at least, those are funds trading with S&P 500 index. So as we said, this index is probably the most popular in the world. And also familiar name Vanguard, iShares. I'm saying familiar name because we already discussed it. Vanguard, iShares, Invesco, and SPDR. Actually, I haven't heard of it myself, but I believe this SPI. SPI is the biggest fund in the world. You see that sometimes names are repeating. So here one Vanguard, here one Vanguard, and here Vanguard, for example. What does it mean? It means that the same company, it may provide several several portfolios to invest into. So it's like a combination of different funds, and you can just choose. And probably under management of the same company named Vanguard. But never mind, those are different ETFs, even so they have name of the Vanguard in the beginning. And here you can see their asset under management. Uh, this looks quite suspicious to me because this number is quite small. Maybe, but maybe not. No, probably it's okay. Probably 300 million dollars um, is believable. Okay, and in Russia we also have funds available. Those are funds available, at least some of funds that are available on Moscow Exchange. For example, SBGB fund invests in Russian FZ, Russian government bonds, FXIT index, which invests in US IT companies. So this is a sector index. RusE, RusE, biggest Russian companies. FXUS, biggest US companies. FXMM, the index which invests in US treasuries, and US treasuries is refers is a reference to US government bonds. And another index, commodity, not index, probably fund. It could be a commodity fund, so fund investing in gold. These are just some examples. They must be all available on Moscow Exchange. So, how to choose a fund? As always, no universal rule can be applied here, but some general concepts you can think about and what you can consider. First of all, you need to define what assets you're interested in. For example, if you decided to, if you want to follow the US market, of course, you would probably need to choose a fund following US market. For example, S&P 500 or Nasdaq Composite if you're interested in tech companies and so on. So, of course, those funds, they do not do this for free, and you'll probably pay something or share your profits. So you need to consider fees and commission of the fund. Sometimes it may be just fee for management. For example, they take, I don't know, 1% of your assets just for the fact that they are managing your portfolio. Or sometimes they may take commission if your portfolio earned something, and then they may take a higher commission on this. You may also pay attention on fund size, or usually it's short, it's named in short like AUM. It stays for assets under management. Probably, um, probably the bigger the fund, it means the more people believe it. So maybe it's reasonable to assume that it's more trustable. Also, definitely, absolutely good idea is to check a track record. To track record makes sense only for um, active management funds. So for funds which offer some smart strategies, because if they say that their strategies are very smart and at the same time they make like, I don't know, negative profits, or their return is 1%, that's probably, it's very questionable why they call the strategy smart. And another thing to follow is a track error. Track error, vice versa, it makes sense uh, for different types of funds. For example, for index funds, because sometimes the fund may say that, okay, I am investing in index S&P 500, for example, and it may be the case that um, they are rebalancing their portfolio in such a way that it does not exactly match the index movement. So they may be not exact in their copying what they're supposed to. So also could be a good thing to check. But I believe for biggest funds, it must be more or less automated or something like this. So probably no need to worry about track record. But just in case, especially if you consider some small or unknown funds, good thing to remember. So and as a general result, you just may use several funds to diversify your assets. For example, you may invest all your money not just in one index, but maybe several indices in several markets, in several sectors, and so on. But as always, there could be no universal advice because all funds are different. It's hard to say. It's hard to say what fund is better than other funds. It always requires analysis, your own preferences, and research. So, any questions on funds? Okay, then let's continue. Let's continue, and finally, we come to the point when we stop talking about separate instruments. We discuss the bonds, we discussed shares, we discussed indices, and we discussed funds. For now, those are the basic types of the instruments you can invest into. And index is not generally, it's not an instrument, but it's maybe a support to understanding instruments like index fund. So we discussed major types of investment instruments, and now we are coming to the portfolio level. So it doesn't matter actually if you include this particular asset in your portfolio or not. It's what matters is how your portfolio performs, right? So this is important. So how to construct your portfolio? What could be a general advice about portfolio composition? So, and this is a slide, with a smell of sarcasm, I think. So you see here um, different proposition from different rich, famous people. So Warren Buffett, we already know him, famous investor, one of the richest people in the world. Ray Dalio. Ray Dalio, the founder of Bridgewater hedge fund, also quite a rich person. Um, German Gref. German Gref is CEO of Sberbank. He is quite famous in Russia and maybe outside of it in some other countries too. So as you can see here, they all give different advice of how to keep your assets. And so, for example, Warren Buffett say put 10% in short-term government bonds, 90% in low S&P 500 in this fund. So, and you remember his bet over the hedge funds. So he's really market index guy. So, and Ray Dalio, for example, is very specific in his advice. 30% allocated to stocks, 40% to long-term bonds, 15% to intermediate bonds, and some percent to commodities like gold, and some percent to other commodities. So, and German Gref just said, okay, 30% stocks, 70% bonds. So, but the main idea of this slide is that, no one knows what is the perfect composition of the portfolio. For any strategy, I believe there could be different advice. And this is a good thing to remember, because if you get interested in investment, you'll probably be willing to take some deeper course on those topics. And just preparing those classes, I noticed that some investment courses, they often make some specific rules, like if you are conservative, I don't know, you need to invest 20% in shares and 80% in bonds, or something like this. Like, like there could be some universal rules, or like they know something that we don't. So you see that even richest people who like really professionals in finance area, they don't have a consensus. So um, always keep the room, for some creativity and some for the fact that circumstances may change. So portfolio composition is a complicated question, but in general, you definitely need to start with define your main requirements. First, you need to define your investment horizon. For example, if you know that you're going to buy an apartment, for example, in 2 years, you need to probably choose a shorter investment horizon, shorter investment instruments. Also define your own acceptable level of risk, because as you remember, in general, it's the higher return is the higher usually the risk. And the asset types. Asset types could be example, for example, I don't know, I am not investing in stocks, or I am not investing, say, in tobacco companies, or I do not invest in alcohol companies just in principle, or something like this. Or I invest only in companies with green policies, like, who care about the nature and the color and so on. So, as I said, do not forget about the risk-return trade-off. I just remind you this um, extremely important concept that, in general, higher expected return, it assumes higher risk. So you see, mm, the higher we are going up on return, the higher is the probable distribution, the wider the probable distribution of the final outcome. And again, this picture we already considered, but still, just to remind you, usually it considered that those instruments from the left, they are more conservative, they have lower risk, and so the most safe instrument usually considered government treasuries, government bonds, like in Russia it would be OFZ. Money market securities are just short debt instruments, like for less than a year. Corporate bonds considered a little bit more risky, but at the same time they give high return. Then we come to equities, like equities from the developed markets, and then uh, equities from emerging markets with high risk, etc. So in general, I think the idea could be written like this, you know, like in very, very, very general terms, it could be something like this. So the closer you are to the left, the more bonds in your portfolio probably are, and the closer you are to the right, the more risk-taking person you are, the more shares will probably be in your portfolio. Also, it could be the question about types of shares, because investing in, for example, I don't know, in S&P 500 and funds as well. Investing in S&P 500, absolutely, it's not as risky, and for example, as investing in, I don't know, stocks of some company in Venezuela, for example. So market also, country market also matters here. So just a reminder. And how to measure risk more, in more tangible form. So what is strange about this stock? Probably I'll just need to tell the answer, because all stocks are changing all the time. But here, if you look at the scale, those graphs, they're usually scaled, and the picture will be approximately the same. But if you look at this scale on the right, you will see that the daily jumps of the stock price could be really, really huge. So this even up to plus or minus 40% a day. This is like, I'm not sure already what was the name of this company, so IVB, but I found it as one of the most volatile companies on the market. So what's volatility? What's volatile company? The higher those jumps in price, up and down, the higher the volatility of the stock is. So that's basically the definition. Those are jumps, big jumps of the company price, called volatility. And the market is said to be volatile if there are big price changes on a regular basis, ups and down. So what's volatility from the mathematical point of view? If we imagine that those everyday changes of ups and downs, they have some distribution, because they have some value. For example, here it could be down for like 40 units, then up for less than 10, then again, and so if we collect um, all those data on how big those jumps were up and down, and we would see some distribution, and volatility is essentially is standard deviation of those distribution. At least if we assume that stock is normally distributed, stock price is normally distributed. So of course, as you know, for normal distribution, I believe everyone knows that the higher the sigma, the higher the jumps could appear on average. The jumps in price, I mean. So this is about risk. Uh, how to avoid risk? Uh, the question is, do you think it's a good idea to invest all your money in companies from the same sector? For example, all money in oil companies? No. Yeah. Thank you for your answers. I'm happy that everyone is answering no. Um, of course, probably not the best idea because, if something happens to the oil price, if you were like this, all your portfolio will be like this. So, and when you invest in the same sector, you just highly exposed to the risk of the sector risk of this company. For example, I don't know, something happens to commodity or something happens to, I don't know, tech industry, and your money is done as well. So what's diversification? The concept of diversification is quite simple. Do not put all eggs in the same basket. So portfolio diversification is a process when you allocate your assets in such a way that their exposure of any particular asset, any particular market, any particular sector is, smoothened among assets. And why diversification makes sense? Because when you invest in different sectors, they are not so perfectly correlated as companies from the same sector, and this approach could reduce volatility of your total portfolio, and reduced volatility is a reduction of risk essentially. So the general recommendation, always to invest in different sectors, to diversify your portfolio. And this is a key concept of risk management. So, but this also decrease profit. Um, true, true, but you mean no, not true. You mean that, for example, if you believe in, I don't know, some sector so much that you want to, actually, only tech is actively growing. Um, yeah, if you believe in such sector so much that you just uh, want to invest all your money into it. So, of course, if the market will just grow, this particular sector, I know all tech companies suddenly grew. So yes, you may make money, but you know, um, here diversification, it's not about the profits. Here we discussing it in terms of risk management. So not diversifying your portfolio, it provides you with exposure to like a really really high level of risk. So, and usually, why diversification is considered a good idea for most people, because if you are a completely rational investor and you do not care about your losses, or you don't, or, you have some buffer of cash, then, and you keep calm whatever happens. But sometimes, not sometimes, but almost always, people, um, uh, let me think of how, uh, loss, and this how people feel. about it. If you were a completely rational investor, um, your feeling would grow linearly, right? Because you only care about money and um, how much you lost. That's exactly how disappointed you would be. But usually, for people, it works something like this. So, oh, sorry, it's not a function, but something like this, more pretty. So, for most people, taking this much risk is unacceptable. So, uh, the problem usually is not that that you invested in same sector, but most people, who invest in same sector because they believe the company will grow, they usually think about um, the possibility that the whole sector may grow up and they may get rich, and they usually do not understand that this is a high risk. So of course, if you are ready for such level of risk and you are actually ready, to lose, half of your money in a couple of days, just for the chance that maybe all the sector will grow and you get twice richer, then maybe this could be your option. But on general, for most people, um, this possibility of loss could be avoided, should be avoided. But yes, that's true. If the tech sector will grow up, then you will not get the profits. But uh, it's like um, in Russian we have such a expression, but I'm not sure how to translate it. But if I were what happened, I would live in other place probably. So diversification is key in terms of portfolio risk management. So if you care about your risks, um, you would definitely not invest all money in the same sector, because this is like crazy risk taking. For some people, probably it's acceptable, but um, take it as a general recommendation probably is not a good idea. So that's basically it for risk management. Not much you can do about losses because no guaranteed protection from losses with keeping return. So it's not possible. You always need to choose optimal combination between risk and return. So currency. Um, the question is what currency you should invest in. For example, you live in Russia, right? All your spending seem to be in Russia. Um, This is actually a complicated question. What currency you should keep your assets in, and there could be no universal rules. This is a very specific topic, but still there are arguments that you should probably hear to make a more reasonable choice in the future. So uh, some some analysts they say that Russian investors should keep some part of their assets in foreign currency. Why I'm talking about Russian investors? Because in different markets those arguments may work differently. So that's why I specify a Russian market. But you may just think if you live outside Russia or if you plan to live outside Russia, you may just think how it could be related to other markets. But logic could be the same. So first of all, why some analysts think that people in Russia should keep their money in foreign currency? Because yes, our spendings are all in rubles mostly, but still, you go every day to the supermarket, you buy some goods, you buy some food, and at least some part of those goods you buy, it depends on foreign currency rate because it's imported from other countries, and if you see the whole chain of of production and how it comes to you, you would see that it's probably directly affected by foreign exchange rate fluctuations. Also, important thing to consider that probably if you want to buy something big in the future, like if you want to buy a car, or if you want to go on vacation abroad, or if you planning maybe to have education abroad and pay for it, which I'm sure I guess is not the option for school tech students, but maybe I don't know, maybe your children or your brothers and sisters will go, and this could be mm. relevant. So if you plan some big to buy something big in the future, then probably it depends on foreign exchange rate. So, for example, car prices definitely depend on exchange rates. If you go on vacation, it's obviously depend on exchange rate because I mean vacation abroad, of course, because you will have to pay in foreign currency. So sometimes it may be from this point of view, it may be the good idea. It may be a good idea to keep some part of your money in foreign currency. For example, if you know that you want to buy a car in 1 year, you may just convert your money in your US dollars, so in euro, and convert them back when the car is here, when the car issue is here. So, and also another argument for rubles to keep some part of your money in foreign currencies. It could be that historically, emerging markets currencies you know they tend to uh, fall rapidly rather than grow rapidly. So um, if you're emerging market, you are somewhere in the middle, and here everything is bad, and here everything is good. So emerging markets, they are usually somewhere in between bad market, badly developed market, and very well developed market. So, and whatever you do, business, politics, I don't know, personal life, it's intuitively clear. Then it's much easier to get from the intermediate state to the very bad than and to get to the best state. It probably takes a lot of time, effort, and this development is usually more gradual. So generally, it's considered that for emerging market currencies, rapid drops in exchange rate are more likely than um, rapid appreciation. They may be neither drop nor appreciation or just appreciation. So still, it does not allow us to speculate. But if you think about this, maybe you'll be more protected. So, and here you can see some statistics of Russian Federal State Statistics Service, Росстат. And here you can see the latest statistics on what is the share of our consumer basket which is imported or which depends. So if it's imported, it probably depends on foreign exchange rate. So, and here on the top you can see the share for food basket. No, sorry, it's not it's not about market basket, because market basket is some artificial composite. It's just share of all food that we have in our country, which part of this is imported. So you see, as for recent data, it's 25%. So 25% of the food on Russian market is imported from other countries. So uh, if to assume that you pick your food randomly, it means that around 1/4 of your food you buy probably uh, depends on foreign currency rate. And the same for consumer goods. Consumer goods are goods that you cannot eat. So you see, for now it's almost 40%. So according to some logic, if you care about the share of imported goods that you buy, so it's about the share of goods that depend on foreign exchange rate. So according to this logic, you may be considering keeping around 30%, some composite of these two numbers, so about 30% in foreign currency. But again, this is like, change in currency, it's psychologically differently accepted by different people. So again, no universal rules, but um, just good point to know when you make a decision. So, however, still, the vast majority of everyday expenditures in Russia are made in rubles, and probably majority of those expenditures do not depend on foreign currency. And again, foreign exchange rates are hard to predict, so it may be the case that you will uh, reinvest all the money in US dollars, and US dollars will drop. So it will be also a pity. And so let's assume that we decided what we include in our portfolio. We made all the analytics, all the research, all the, I don't know, we read all the news and bought all the shares. And what to do next, right? Portfolio continues to live, continues to develop, and how to act in accordance to this. Actually, this will be probably the last slide of this presentation. I decided not to, go too deep into portfolio management. Why is that? Because there could be really no universal advice how to act when something happens to your portfolio. Because as I saw, many courses on investment, they like make really very strict rules. Like, I don't know, you invest 20% to shares, 80% to bonds, and then when your shares go down, you immediately buy them, uh, buy additional shares to make it 20% again. So this is, it doesn't work like this, at least for individual investors. To make some strict rules, from my point of view, it's uh, super unreasonable. So first of all, you may choose a passive strategy. Passive strategy, and when you invest in some fund or invest mostly in bonds, and you just receive coupons and maybe reinvest in them. So it does not usually require much action from you. So there could be no management. So just follow your plan, buy what you wanted, and just wait. How it works out. But if you choose an active strategy, then mm, probably not a perfect advice, because everyone expects some specific advice, but there could be no specific advice. So you just need to follow market news, follow the analytics, and follow what's going on with the companies you invest in, and you should act in according to what you see. Maybe you see that um, you chose one company from IT sector, and now you see that some other company is getting better than the company from your portfolio. So maybe you just switch them, or maybe maybe you understand that the company, one of the companies you invested in, it's not doing so good as you expected, like on average, uh, not on one day, because in one day everything may happen, but you understand that their business is not developing as well as you expected. For example, some new account report came out or something like this. So uh, you may choose in this case to exclude it from your portfolio, for example. So no universal advice here. Um, just read what's going on, understand what's going on, and act in accordance to this. Also, when you just begin your investment life, if you begin your investment life, it could be a good strategy to start with a very, very conservative instruments like bonds or some conservative funds. And of course, the higher risk you take, the higher competence it usually requires, and the higher understanding of analytics, the higher understanding of accounting or on the sector specifics and so on. So it could be a good start to start with very conservative instruments like bonds, and then you may diversify your portfolio to add more shares along with your competences growing. So you learn new things, and when you feel comfortable, you may expand the asset types that you invest in. Next advice, which could be probably general, for this is really universal, no exceptions, that could be very specific. Do not panic, because if you panic, you'll lose money for sure. I'll just try to draw why that's so. For example, you have your portfolio like here, um, and suddenly the market crash starts like here. If you're panicking, you'll probably sell everything you keep in, because you're afraid of market price uh, loss. Um, Probably I'm drawing it so that it will look like panicking is a good example, but never mind. Okay, and usually then it goes up, and if you start panicking that you sold it, you will probably buy it somewhere here, because if you tend to panic, that you will not probably buy it until you make sure that it is going back up. So usually people act something like this. When it's going down, people sell. So people tend to panic, and people tend to sell at lower price, and then they tend to buy on a higher price when it's growing up. So usually they wait until it is for sure that the market is growing. So uh, maybe this is not the big picture to illustrate this, because you could say, okay, you should have bought it here. Mm, when I just opened my brokerage account, literally in 1 week or 2 weeks, there was a small market crash, and I was telling about this to my former colleague, and she said, uh, "Sonia, why are you using such a stupid strategy? You should always buy, when the market and it's down. So when the market is here," she said, okay, it's clear that you need to buy assets here and sell it here. Um, and this was quite funny, because you never know how it happened, and if everyone knew when it happens, probably everyone would do this. So I hope I tried to explain what is not a good thing to panic. I hope you believe me. Uh, Another reason not to panic, because losses always happen. So if you start investing, especially in shares, you will definitely lose money at some point. Sometimes you may even lose a lot of money. Um, it happens to everybody. But the main thing is that to understand why you lost money. So if you lose money all the time and you don't understand, um, this is like a lose-lose, because you're losing money and you'll probably keep losing them, because uh, the reason maybe in your portfolio, maybe some company's strategy changed, or they announced something, and if you don't understand it, that it's definitely a bad thing. So, and the last advice would probably be to do a regular back testing and to check if your portfolio acts as you expected. For example, if you expected this portfolio to be of low risk, and for some reason there is like extreme volatility, for example, your portfolio of bonds, I don't know, if you have portfolio of bonds and it started behaving like this, then probably in general, it may not be the case. With classical bonds, it may not be the case. Maybe just by mistake you bought some, I don't know, some convertible bonds or some specific structured instruments, or something like this. Or maybe when you invested in some type of shares, and then oil goes up and your portfolio goes down, and so um, you need to check if it works at least approximately how you expect it. Of course, you cannot predict how your portfolio will behave, but at least you may compare some general level of volatility, general level of profits. Because again, when you invested in very, very conservative instruments, and in 1 week you have extreme high profits, this is suspicious. So you may also understand why is this, because maybe tomorrow these profits will go back. Um, so just check if it acts as planned, not as planned, as acceptable, and maybe make some adjustment in accordance to this. So that's basically it at all for our slides. And home assignment will be in Canvas. I'll upload some quiz on investment instruments soon, maybe until the end of today. So that's it for the content part of our course. So if you have any questions, please ask, or we can discuss them, or you can write me. I don't know, if you have any questions after the course, or write me into the Telegram chat. Maybe I'll try to help you. So, questions? Okay, no question. Then I hope this material was useful to you, maybe partially interesting. So I'll see you tomorrow. Don't forget that we will start at 9:30. So please, if you have any questions, ask me or write me in Telegram. So I'll see you tomorrow. Thank you very much. Is presentation tomorrow? Yes, presentation will be tomorrow. Thank you, Anna. Mm, thank you very much. So, okay, see you tomorrow at 9:30. If you have any problems with this time, please let me know and come at 10. Thank you very much.